Welcome to FX Street. Thank you for coming and watching. We're going to go over an interesting thing on time cycles in cryptocurrency markets, but it's really applicable to every market. Before I get into that, I'd really encourage you to head on over to YouTube, to our FX Street channel, hit that subscribe button so you can be updated to all the content that we are producing here for cryptos and the foreign currency markets. And also follow us on Twitter at FXS Crypto. Now, what I'm going to talk about today may seem a little on the weird side, but I can assure you it is a very useful tool to use in your analysis because, really too often we focus so much on price. But for those of you familiar or unfamiliar with one of the fathers of technical analysis, W.D. Gann, who's kind of an enigma, and I'm definitely predominantly a Gann analyst when it comes to my form of technical analysis. But Gann focused really on time. You've probably seen his tools where there's angles and boxes and squares. That was just a small part of his work. His focus primarily was on time cycles, and he was, his big thing was saying that time is the reason that trends change. And he had several tools that he used and developed. One of them is the Square of 9 tool. These were used to forecast future prices at future dates, referencing back to important levels like anniversary dates like of important swing highs and lows, all-time highs, all-time lows, and then building off of those dates. And he used some other tools too, like the Square of 4, Hexagon, his Wheel of 24. There's multiple tools, and it's impossible to go into any real lengthy detail with these in a short 5 to 6 minute video. But there is something that is very useful that can be taken today, and you can try it out for yourself and take a look at it. So there are several cycles in Gann's work that he utilized and that he identified, and these ones are cycles of the inner year, and basically they're separated. If you look at the Square of 9, you'll notice that it's segmented out like a compass and by degrees. So you have 0, 90, 180, 270, and then a full circle is 360. These are also day counts. And in Gann's cycle of the inner years, Gann's cycle of the inner year, the most important subdivisions that he identified was the 90-day cycle, the 180-day cycle, the 270, and then the 360 or the 0 degree. And he mentioned that, the cycles, once they culminate, if something's been trending for 90 days, there's a very high likelihood that some type of swing high or low, major minor swing high or low, will likely develop there. Same with the 180, the 270, and the 360. Also, there's a little bit of a bubble that he gives for it, a little bit of a variance. So depending on the slope and the speed of a trend up or down, 90 days can extend to 98 days, 99 days rather. The 180 can go to 196 days. The 198 days. The 270 can go to what is that? 297-ish, and then I believe the 360-day cycle can get pretty close to the 400 days. So there's a little bit of a variance given for a lot of these, but the point is not to identify that it happens exactly on that level. It's just something to pay attention to, that if your oscillators are indicating that something's extremely overbought or extremely oversold, and something's hitting new all-time highs, and it's in a 90, 180, 270, or 360-day cycle, that there's a high probability that prices are going to not necessarily have a broad trend change, but there's a high probability of a correction at least. And I went ahead and spent some time this morning just kind of highlighting some of these on Bitcoin's chart. And here's a 360-day cycle. This would be from the Mt. Gox low and then going out to the max of that 396 days. Does it identify the extreme low? No. Is it pretty close? Yes. Then you have another cycle from the swing low down here in 2015. 297 days, that's part of the 270-day cycle, very close to that swing high. And then when you just build it off looking at different 90-day cycles, there's a fairly high chance that Bitcoin will, develop some type of major minor swing high or low 90 days from a major high or a low. And so you look at this date, September 17th, 93 days, which is inside that 90 to 99 day range. 93 days from September 17th was the December 2017 high before the beginning of that very prolonged bear market. And 90 days from that, you got to pretty close to this swing low here. 363 days from that high, you kind of established this minor swing low here. That's 198 days. But then 360 days from there, from December 17th to the December, almost exactly 1 year, you get to that December 2018 low. And so, I mean, you can just look at these as I scroll through them. Does 90 days from a swing low mean it's going to develop a swing high? No, not all the time. This is where you really got to use some common sense and look for some confirmatory analysis, such as your oscillators. Whether you're using something like the MFI, the RSI, the composite index, or several. There's a lot of tools that help confirm whether or not the cycle that you're looking at, 90, 180, 270, 360, if something is trading at a major low there and the oscillators confirm it, there's a fairly high chance that you will be able to identify some type of major minor swing high or low. And again, the 270 from the June 19 high to the COVID crash low there. And then you go from the COVID crash low in March, on March 13th of 2020, 392 days, you get to the swing high that developed here back in April of 2021 that kind of preceded this drop. 90 days from that April 14th, 2021 high, 97 days, you had the low. 90 to 99 days from there, we got close to that swing high. And that brings us to now. Are we at or near a swing low for Bitcoin right now, where we should anticipate seeing it move higher? There's a lot of other cyclical ranges that culminate really around March 21st that indicate, yes, that is something that we should see, or at least we should see some type of big move occur up or down, but definitely within a date range for that to happen. So again, you may find this useful, you may not find it useful, but it is something else other than a lot of the normal technical analysis that you can find in different places. I just thought that this might be something that's very interesting for people to look at and use, and may find helpful in their own analysis when it comes to timing, where a market might turn, which is dangerous to do. But this is something that I think is very helpful in at least giving someone a good high probability chance of finding that. So again, thank you from all of us here at FX Street. Please don't forget to join our YouTube channel, hitting that subscribe button, follow us on Twitter, and don't forget to like, comment, and subscribe.